Hey, it's Matt from Financial Sense, the #1 accounting practice management software. And we know that whether you're taking a vacation, making big changes at your firm, or just going about business as usual, the world of accounting spins on without stopping. So, if you've missed the latest industry news, we're here to help. And we're back with the latest episode of the only show that asks the question, what's new in accounting? First up, let me take you to the land down under, where the Australian government is currently considering something that's never happened anywhere in the world, forcing the big four accounting firms to break themselves apart. We're not talking about a fine or a slap on the wrist, we're talking about an actual structural breakup, and it all traces back to one whistleblower and one accounting firm, KPMG, that thought nobody would notice. Let's walk through how we got here. Currently, KPMG Australia is embroiled in a scandal after a whistleblower alleged the firm misused confidential client information to win audit work. Specifically, the allegations, made public back in March, accuse the two audit partners of using confidential lend-lease information to help win other lucrative audit tenders. It's the kind of thing that sounds ultra-technical until you translate it. KPMG's own auditors allegedly took information only they had access to because they were trusted with a client's books and used it to pitch another business. That's the exact conflict of interest nightmare that audit independence rules exist to prevent. And this didn't stay contained to two partners. The firm's CEO and audit chief had already been tied to the scandal. Then, on June 23rd, KPMG Australia's chairman Martin Shepherd and senior audit partners Paul Rogers and Eileen Hoggett resigned. Rogers and Hoggett were the two partners directly named by the whistleblower, and both are currently under investigation by Australia's corporate regulator. KPMG's interim CEO Stan Stavros didn't even try to spin it, saying, "The decisions announced today are necessary and immediate. We did not meet the standards expected of us, and we recognize the impact this has had on the whistleblower, our people, our clients, and the community." KPMG also said it would appoint an independent chair and add independent members to its Australian board. Australia has seen this before. Back in 2023, PwC was rocked by revelations it shared confidential tax policy details to win clients, which forced it to forego new government contracts for more than a year and sell its government advisory business, which had accounted for a fifth of its revenue at that point, for a single Australian dollar. That pattern is now repeating with KPMG. Reuters' analysis of big government tenders found that new contracts the Big Four signed with the federal Australian government totaled $348 million in 2025. That's down from $637 million the year before, nearly cut in half. KPMG alone has about $650 million of active government contracts, and a former partner warned that losing hundreds of millions annually in government work could threaten the firm's financial health. When your government client base starts quietly reviewing every contract, that's not a PR problem anymore. That's a money problem for your firm. And the story has only gotten bigger because the scrutiny has stopped being just about KPMG. On July 8th, Australia's corporate regulator, AICPA, launched a review of audit conduct complaints across all four firms, KPMG, Deloitte, Ernst & Young, and PwC, examining internal and whistleblower complaints about the misuse or sharing of confidential information while continuing its separate formal investigation into KPMG. But AICPA admitted something that's very telling about its own limits, with one regulator saying, AICPA's jurisdiction in relation to audit firms, as opposed to individual auditors, is limited. That's because AICPA doesn't have broad legal power to regulate partnership-based audit firms the way it regulates listed companies. But that gap is about to close. On July 1st, Australia's Treasury didn't just propose more oversight, it proposed dismantling the business model in a consultation paper recommending a split in the Big Four's audit and consulting arms, or alternatively, capping partnerships at 400 people, the strongest regulatory response we've seen thus far to both the KPMG whistleblower scandal and the 2023 PwC tax leaks. Assistant Treasurer Daniel Molino didn't play around, saying, "In recent years, we have seen behavior from some large accounting, auditing, and consulting firms in Australia that is not fair and honest." This is a big shift from 3 years ago, when the Australian government treated the PwC scandal as one bad firm crossing a line. Today, the Treasury is treating the entire structure of the Big Four as a problem. And on July 16th, Australia's government directed ASIC to improve regulation of accounting and auditing firms, aiming to enhance accountability, transparency, and oversight of the audit sector. The government didn't specify exact next steps, but it did confirm breaking up the Big Four remains one option under active consideration. Scandals involving the Big Four have happened before, but what makes the situation in Australia different is the scale of the response. No government has ever seriously floated forcing a Big Four firm to split its audit business from its consulting business by law. And if Australia actually does this, every other country is going to be watching closely, because it would be the first crack in a business model the Big Four have run globally unchanged for decades. Now, if you're watching this, chances are that you're not part of a Big Four firm and you're not in Australia. But this is exactly the kind of story worth knowing regardless, because it's a preview of where audit and advisory regulation is heading globally. Trust, transparency, and conflict of interest firewalls are becoming the price of doing business, not something that's just nice to have. Firms that can already show clean audit trails, clear separation of duties, and documented client confidentiality practices are going to look a lot more attractive in a market where Big Four no longer automatically means safe. Next, what if I told you the IRS could show up at your client's door in the year 2046 for a return filed in 2026, and there's nothing your client can do about it? That's not a hypothetical anymore. The Supreme Court just let a ruling stand that removes the IRS's 3-year audit window if a preparer committed fraud, even if the client had no idea, no matter how long ago it happened. Let's break down what every firm needs to understand. On June 22nd, the Supreme Court declined to hear the court case Murren v. Commissioner, leaving a Third Circuit ruling in place that significantly expands the window during which the IRS can go back and assess unpaid taxes when the person who prepared the return committed fraud. And here's the kicker you'll definitely want to pay attention to. The ruling holds even if the taxpayer didn't know anything about the fraud. It all stems from an instance when a taxpayer named Stephanie Murren was assessed taxes and penalties in 2019 based on returns filed from 1993 to 1999 completed by a preparer, not by her. She now owes $328,000 plus interest for returns filed 26 years before the audit even started. Now, normally the IRS has a clock ticking on their audit, 3 years from the date the return was filed to assess taxes. That's found in U.S. Tax Code Section 6501A. It's the rule that lets people eventually stop worrying about old returns. But there's an exception. Under Section 6501C1, the IRS can assess tax at any time when a false or fraudulent return is filed with the intention to evade tax. That exception has always existed. What's new, and what the courts just decided, is whose intention counts. Murren argued the fraud exception should only kick in if she intended to evade tax. Her preparer's fraud, in her view, shouldn't erase her own statute of limitation protections. The Third Circuit disagreed. The court held that the extended statute of limitations did not require the intent of the taxpayer to evade tax to apply. Nothing in the statute implicitly indicates that the intent to evade tax must belong to the taxpayer. In plain English, it doesn't matter whose fraud it was. If fraud touched the return, the clock never started. However, even the judges who ruled against Murren admitted this feels rough. According to the Third Circuit statement, "We understand Murren's frustration with the IRS's decision to assess tax beyond the statute of limitations due to the wrongdoing of someone other than her, but we are bound by the statute. Because the statute is agnostic about who must intend to evade tax, we hold that taxpayer intent is not required." Murren's own attorneys spelled out exactly why that's dangerous for regular taxpayers. Allowing assessment without time limits is devastating for taxpayers who, due to the passage of time, not any fault of their own, cannot prove the accuracy of their tax returns or the fraud, or lack thereof, by their return preparer. Those taxpayers are left to defend their tax returns when the government suddenly appears unannounced, out of nowhere, asserting massive tax liabilities from decades earlier. Suddenly, taxpayers could be in a position where they have to defend a return they filed in 1995 with records they probably don't have anymore. Unsurprisingly, there's a real split in how federal courts read this law. The Third Circuit's holding directly conflicts with the Federal Circuit's taxpayer intent requirement from a separate case, BASR partnership versus United States. That means depending on which circuit hears a client's case, the outcome could completely go in different ways. The Supreme Court chose not to resolve that conflict, for now. One tax attorney flagged an unresolved question that practitioners advising on voluntary corrections will need to weigh carefully: whether a good faith amended return correcting a preparer's fraud can ever reclose the year. So this isn't settled law. The rule currently applies most clearly in Delaware, New Jersey, Pennsylvania, and the U.S. Virgin Islands, the jurisdictions covered by the Third Circuit, though it may influence cases elsewhere. The main takeaway for you and your clients is to understand that the ordinary 3-year window for assessing tax remains the default, and taxpayers aren't automatically treated as fraudsters because of a preparer's misconduct. Fraud penalties are still generally dependent on the taxpayer. Your client isn't going to jail over a shady preparer, but the consequences of preparer fraud can still follow taxpayers who never personally intended to evade tax, for years or, as in this case, decades later. This case is a reminder of how important it is to choose tax preparers carefully, and it's a message accounting firms can use to differentiate themselves. Being the buttoned-up, well-documented, quality-controlled firm that clients can count on is more attractive than ever. Besides being another reason to market yourself well, this ruling gives anxious clients even more reason to ask harder questions about who's touching their returns, and it's on you to have good answers. Documentation, review trails, and clean workflows are crucial if a client ever gets a letter about a return from 20 years ago. Okay, let's take a quick break. Every accountant needs a hobby outside their profession. Sometimes it's woodworking, sometimes it's skydiving, but every so often, an accountant makes something that changes the world. One accountant who did that was Walter Deemer, who, all the way back in 1928, created the modern bubblegum recipe that's led to the creation of an entire industry. See, Walt was working as an accountant at the company Fleer, which was making trading cards and had also created their own bubblegum recipe in 1906 called Blibber Blubber. Okay, now they're just trying to make me trip up on camera. But Blibber Blubber was fine for blowing bubbles, just wasn't as good as regular old chewing gum. However, outside of his accounting work for the company, Walt liked to experiment with gum recipes as a hobby. Eventually, he created a gum that could stretch more easily without breaking and also not stick to your face. The result? A gum that could easily blow bubbles with and not make a mess when it popped. To put it to the test, Deemer used a saltwater taffy wrapping machine to make 100 pieces of the new gum, colored it pink because that was the only color food dye they had, and put it at a local candy store. The gum sold out in one day, and Fleer used it to create Double Bubble, with Walt teaching salesmen how to blow bubbles with it to get the gum sold to shops. Wow, that was what sales positions were like in the 20s. Lugging a suitcase full of bubble gum and blowing bubbles to make a sale. What a time. Anyway, what I find really interesting is that Walt never patented his recipe, leading to his bubblegum formula being used by all sorts of companies and becoming a hugely popular type of inexpensive candy. He also apparently never received royalties from it, but he did become a vice president for Fleer, going on to ride around on big tricycles and pass out bubblegum to kids after he retired. Looking back on his invention, Deemer said, "I've done something with my life. I've made kids happy around the world." What can I say? The man clearly loved bubblegum. So have a stick of gum in old Walt's memory today. Personally, I like peppermint. It's refreshing, but not too spicy. Honestly, I kind of can't stand the fruit flavors. It sort of feels like someone just filled my mouth with soda syrup, but without the refreshing bubbles. But that's just me. And now, I will try to blow a bubble. It's not going to happen. And for our final topic of the day, the AICPA published a brand new auditing standard this month, and it's the first real update to how auditors confirm cash and other balances in years. Let's break down exactly what changed and why it actually matters, even if your firm doesn't do a ton of audit work today. The AICPA's updated standards document is called Statement on Auditing Standards, or SAS for short, number 150, External Confirmations. It was published on Monday, July 14th, resulting from a vote by the AICPA Auditing Standards Board back in May. It's not a minor tweak buried in a footnote. The Auditing Standards Board itself described it as a move to modernize how CPAs obtain audit evidence through external confirmation procedures. And if external confirmation sounds very broad, what it actually applies to is the process where an auditor goes directly to the bank or another third party and gets independent confirmation that the numbers a client has given them are in fact real. It's one of the most basic trust but verify tools in the entire audit process, and the rules for how you're supposed to do that just got rewritten for the first time in quite a while. The most significant update is a new requirement for the auditor to perform external confirmation procedures for cash and cash equivalents held by third parties, except in the case of certain specific conditions. That means confirming cash balances with an outside source isn't just a best practice that auditors can choose to skip anymore. It's now the default requirement. If you want to skip it, you need to meet specific conditions that justify skipping it. That's now the exception, not the rule. So, why does this matter? Because cash is the single easiest place for fraud to hide, and it's exactly the kind of thing that regulators want locked down tighter. An auditor just accepting a client's own bank statement without independently verifying it creates a gap. This standard closes the gap. Here's where this standard actually catches up to how the world works in 2026. SAS number 150 acknowledges direct access to information maintained by a knowledgeable external source as a way to satisfy requirements related to external confirmation procedures, and provides related guidance on how to do it. So, if an auditor can log into a secure third-party portal, like a bank's confirmation platform, and pull verified data directly, that now counts as a legitimate confirmation method. Auditors aren't stuck mailing paper letters and waiting weeks for a signed response back. The standard updates existing guidance to reflect the increasingly widespread use of intermediaries in external confirmation procedures. That's a meaningful shift. A huge chunk of confirmation work today already runs through digital intermediary platforms rather than physical mail, and now the AICPA is formally recognizing that reality and giving auditors clear rules for how to rely on it, instead of leaving firms guessing whether a digital confirmation will actually hold up. The standard also establishes new conditions that must be met when using negative confirmation requests. Here's a quick refresher for anyone who needs it. A positive confirmation asks the third party to respond either way, confirming or denying the balance. A negative confirmation only asks them to respond if something's wrong. Silence is treated as agreement. Negative confirmations are faster and cheaper, but they're also weaker evidence because the party might just ignore the letter instead of actually checking it. This update tightens exactly when auditors are allowed to lean on that weaker method. AICPA's chief auditor Jennifer Burns framed this as catching the standard up to how audits are actually getting done today, saying, "External confirmations remain a critical source of reliable audit evidence, and these updates are designed to strengthen that foundation in today's increasingly digital and intermediary-driven environment." That's the common theme across all three changes. Cash confirmations become mandatory by default, digital access becomes a formally recognized method, and negative confirmations get more guardrails. Three separate adjustments, one goal: making sure confirmation actually means something in a world where most of this data lives on a screen, not in a mailbox. But there's no need to panic about a scramble this tax season, thankfully. The standards update becomes effective for audits of financial statements for periods ending on or after December 15th, 2028, although early adoption is possible. That's more than 2 years out, so the AICPA is giving firms real runway to update their audit programs, retrain staff, and adjust client communication templates well before it's mandatory. So, even if you're not doing full audits day to day, this is worth flagging to your client-facing team members, because it signals where the profession's quality bar is heading. Less tolerance for taking a client's word for it, more expectations that verification happens through direct, documented, third-party channels. If your firm does any attest work, or if you're advising clients who will eventually need an audit, 2028 sounds far off, but audit programs and client onboarding templates take time to update properly. Better to start building that habit now than to get real stressed out about it in a year. Alright, that was a lot of big updates in the accounting industry, and if you're wondering what you can do for your firm in the midst of so much change, Financial Sense might just be the upgrade you need. It's an all-in-one accounting practice management platform that's helping more than 10,000 accountants and bookkeepers manage their workflows, seamlessly collaborate with clients, collect payments, and so much more. Here's just one Financial Sense feature that firms love: the brand new AI file renaming. It's designed to save firms countless hours by renaming client documents according to set naming conventions and instant contextual analysis. Once turned on, anytime you have a client upload a file to a client task or into their client folders, the agent will read through the file, identify how to name it based on your naming conventions, and then complete the rename. No more digging for the right files twice, no more costly back and forth during the busiest times of year. Now you can save time and keep your records straight with AI file renaming. It's just one of the many features from Financial Sense that's helping firms make the most of every day. Want to know more? Click the links or scan the QR code, and thanks for watching What's New in Accounting.